I just had to explain to my 27-year-old sister how a mortgage works. And I realized if you haven't bought a house before, you probably also don't know how a mortgage works because, of course, they don't teach you that in school. Just to explain a little bit more detail, if you plan on buying a house or investing in real estate, buying some sort of property, unless you're going to buy everything in all cash, you're going to have to get a mortgage. You can use all cash, it can be helpful in negotiation, but it's pretty expensive. Personally, I don't buy things in all cash because I want to use my cash more strategically. I want to invest it in different properties and different assets. And instead, I use a mortgage, which is basically debt. And debt isn't necessarily bad. It's just useful to pay for things over time. Let's say you're buying a house, so you go talk to a lender, bank, whatever, and you're trying to get your mortgage loan. The first thing they're going to do is they're going to figure out, is this person creditworthy? Are they going to pay back the loan? So they're going to check all the other loans you have, the repayments on those, your credit cards, an auto loan if you have it. They're going to check your debt to income, just verify that if you take on more debt, you'll be able to pay down those loans based on the income amounts you have. And so they'll make sure you qualify for it. At that point, you get appraised, and then let's say you get the actual loan. That will fund the house. And so let's say you bought a $500,000 house, you put $100,000 down, you have a $400,000 loan. You're going to make monthly payments on that loan over 10, 15, 20 years, depending on the loan term. And when you finish that loan term, you're going to have paid more in the total amount of interest and principal than $400,000, what the original loan was. $400,000 is what you call the principal, and then interest is baked into the monthly payments you're paying every month, depending on your interest rate. Lower interest rate is better. You end up paying less per month. So that interest, because money's not free in the world, adds up on top and makes that overall repayment over, say, 30 years more than $400,000. Outside of principal and interest, there are two other things you're going to need to worry about on a monthly basis, or could be semi-annual. That's property taxes and home insurance. So property taxes, basically, you're going to pay every year, even if you own the house outright. Even if you pay cash, you'll still pay property taxes. It's for the general services of the community, the roads, the schools, emergency services, etc. And you should really be careful when you're budgeting for this, because you should expect that it's going to go up pretty much every year. Maybe it'll stay flat, but it almost never goes down. And so you'll see that monthly amount you're paying if you're escrowing property taxes into your monthly payments. You'll see that monthly payment slowly goes up over time. And so budget for that, make sure you're ready for that, and expect that it'll rise slowly over time based on just taxes rising in your area. The other thing is home insurance, like I mentioned. So it can actually be really expensive depending on where you are. If you're in Florida in a hurricane zone right now, it's really hard to get home insurance. And basically, most places won't even give you a loan if you don't have home insurance. It's attached. So you should make sure you actually, early on in the buying process, figure out what home insurance you'll qualify for, what those payments will be, how expensive it's going to be, because it can actually add up to quite a bit higher of a monthly payment than you expect. So that's a quick rundown: principal, interest, taxes, and insurance. That's the kind of acronym you should think of when you're thinking of paying down the monthly payment for your house. If you guys have any questions, drop them in the comments. Happy to give that, and follow me for more posts like this.